All right, welcome back to Two Super Guys Trade Stocks. I'm Vinny.
I'm Dylan.
And today we're going to talk about the poor man's covered call. It's my first foray into this little world. It's kind of cool, catchy options trading strategy name, which sounds super fancy if you told people you did this for a living.
I do a poor man's covered. I like the iron condor. I don't know how to do it. Cooler name though.
Yeah, Iron Condor, Iron Butterfly, pretty cool names. Maybe we can do some more of those sort of things. I've never tried one before, but
Yeah.
so if you guys enjoy this kind of entertaining stock market kind of content, please go ahead and subscribe below if you're new here. But that's what we're all about here at Two Stupid Guys Trading Stocks. So, poor man's covered call. So basically, what is this? There's another fancy name for it. It's a diagonal calendar spread is another fancy name for it, but poor man's covered call is good enough. Basically, you're buying one option and you're selling another one. And you're taking advantage of the difference in theta decay, which is time decay. So you're buying an option that's further out date-wise and is in the money, meaning that if you exercise it today, would be worth some sort of actual physical value. And then you're going to sell against that position some shorter dated options that are out of the money, hoping that the stock doesn't hit that price, therefore they remain out of the money, and you just simply collect that premium you're paid. All right? Yeah, no, right? So it's all about collecting that theta decay. The theta farming, some people will even call it. You're just collecting that decay in time value.
Some people call it theta farming. That's a pretty awesome term.
Theta farming is pretty cool. That's another cool occupation. I'm a theta farmer.
Yeah, that's pretty awesome. Sounds really smart.
Yeah. So this right here, this graph really encapsulates what you're trying to do, right? You're buying an option that's down here. It's long. It's got a long time to go before it expires, and it's well within the money. Well, this isn't really showing in the money per se, but it doesn't have that exponential drop off that an out of the money option does as it accelerates towards being kind of worthless, basically.
Right.
So you're, like I said, you're buying this and you're selling this against it. You're trying to take advantage of both the spread in price and the spread in time. So right. There's a difference here, both at X and Y axis. So what kind of companies do you want to be doing this on? You want to be doing this on companies that you're slightly bullish or you think will have a mostly flat stock price, right? You don't want to be doing this on your Palantirs, right?
Would not be a good call.
Yeah, it's a different way to make money, but those things can quickly blow right through your short call price. So that's a little tough. You also want highly liquid options. You need to be sticking to well-known companies. You start trying to do this on random little penny floats, short float stock. Basically, you get yourself in trouble because there might not be but two other people trading options on that company, and it'd be hard for you to exit your position.
Yeah, I just ran into that problem, actually.
Yeah. And you generally want an implied volatility below the 50 percentile, meaning a company that's more stable. Still, once again, you don't want to be paying a lot of money up front for that long option with something that's got high implied volatility. So what did I end up picking? This is Bank of America. That's a pretty nice chart, isn't it, Dylan?
It is. That's a pretty solid chart.
1 year chart, just kind of staying above that 50-day moving average, just kind of perseverating on up there, nice and consistent. So what I did on May 18th, sorry, I bought to open the January 22nd $37 call, and I paid $7.05 per share for that. So Bank of America is trading at about $42 a share. So this is $5 in the money, meaning that this has $5 of intrinsic value and like $2 of extrinsic value. Pretty good ratio, I think. That was about what we call it, a 70. It was like 74, 75 delta. Don't get too caught up on that. That's just a way to kind of look at how in the money this option is. Okay, and I sold against that, expiring a few days later, and I $44 call, and I collected $18 in premium, 18 cents per share. But that was a few days later. Like I said, I let that first one expire worthless, so I collected it all. I took all $18 and ran home with it. And I repeated the same thing again on Monday. The following week, I sold another $18 call. Collected another $18 in premium, selling a weekly $44 call on Bank of America. That one I ended up rolling out instead. I was already at like 80-something% profit, so I just went ahead and rolled it out. I paid $4 to buy back the thing I had sold for $18, and I opened a new position, a little bit longer dated. call I sold for 39 cents a share, so 35 cents came into me, so I collected $35 for this. So where we stand today, the long option is currently we're at 678. I paid 705, so it's lost about 20 cents or so in value, but I've collected now 71 cents in premium. And if I were to do the math out, my poor man's covered call strategy right now, as the options I have sold, covers about 38 days, right? If we do this math where I collected 71 cents per share on something I paid $7.05 per share, it's about 10% or so in 38 days, assuming this expires worthless. If you annualize this out, that's a 96.7% annualized return rate.
That's very good.
Yeah. That's what's up?
What happens if the stock tanks?
Well, that's the thing. I'm at $37, so I have some room to come down, right? Bank of America could lose $5 a share, which is a sizable move for them. They're not that kind of company to drop all of a sudden 12% or so. But
yeah,
I could get in trouble if that were to happen. Yeah. That's why you still have to have confidence in the underlying equity that it will appreciate over time. That's your real kind of real hard part, is finding the companies, I think, in which to do the poor man's covered call. At least for me, it personally was.
Right.
I own Bank of America in my main account, so I'm kind of bullish on them. And the financials should see a decent bullish run here as interest rates kind of the yield gap kind of increases there. But that's why I was like, yeah, this is a good one to try it on. It's a stable company, liquid options.
So really, any company that you had no plans of selling for at least a year.
Yeah, that's the idea. Is that you'd be able to hold them for about a year, or at least a year. Yeah.
All right.
Not your power.
I've never seen. I don't ever do those spreads because I don't have the patience. But that return's pretty nice.
Yeah. I mean, there's that's a pie in the sky annualized return. The likelihood of being able to achieve that, I think, is questionable.
Well, I mean, they went from 25 to 42. Imagine your call option if it goes from 42 to 47, because then you're also going to have a giant return. Plus on the shares that you already own, so it's like a three-way. Yeah. As long as that stock doesn't tank, you're exceptionally getting a small amount of premium for the short ones, for a levered return from the call, and then the shares are going up as well.
Yeah, exactly. Yeah, you can be thinking of it as using the premium you receive to reduce your cost basis on that call option as well. So if I were to think of it at that point, the 71 cents, I paid $6.30 basically for the right to buy, Bank of America at $37 a share for the next 6 months.
Yeah, that's pretty awesome.
Yeah,
that's pretty dope.
Are we going to see a poor man's covered call in Dylan's portfolio sometime soon?
Well, because we're doing the stim challenge, I'm going to have to stick to my long out of the money calls because it got me in first place. So until that fails.
Yeah, exactly. Look for that video coming out this week.
Yeah.
All right. Well, thanks for tuning in, guys.
Thank you.